presence. So what I mean by that is they typically had a Facebook and Instagram account. The lower risk people and people who behave better tend to have Facebook, Twitter, LinkedIn, Instagram, and Pinterest. As soon as you throw in LinkedIn and Pinterest, your risk probability of the person defaulting drops exponentially. As soon as they don't have that. So it becomes more a case of understanding the customer base, and it's unique and specific to each organization. So someone like, I don't know, a MTN contract will perform very differently than a Jetstar account. You've got to analyze the existing market and categorize the ABC ranked customers first, and almost build a persona of them of your existing base before. So you almost need to use the information and the data benchmarked against your existing customer base to build that persona. It can then further be utilized for marketing initiatives, so to speak. So you can take that drill down data of knowing where your category A customers are from a digital perspective, drill that down into which platform do they actually spend the most time on, because that's information that we can provide. So you may be present on Facebook, Twitter, LinkedIn, Instagram, TikTok, but a 24-year-old ideal customer is not spending most of their time on Pinterest or on LinkedIn. They're on TikTok. So your digital marketing activities need to be focused on there. So there's multiple areas of being able to drill the data down. We like to say buy it once, use it many times. But to answer your question in short, it's specific to each business, each environment, and each sector. But it's the correlations that we can assist with.
Cool. Any other questions? Okay, Murray.
What are you looking at investing in the new year? What's coming up?
We've got, just to give you a feel, we had 27 investment ideas presented to us this year. And we've got, separate to the ones that we did deploy, capital we did deploy, which was Borpa, Ferocian, Mandini, and Chapico. We've got at the moment what we call kind of pre-IC. So of those 27, most we've said no to. We've got 5 at the moment which are kind of going into pre-IC. One is a training business, one is in the water infrastructure space, one is in property. We like that. We don't have much property exposure, so it's an interesting theme to bring in. One, we actually quite like this. We were approached by 2 companies, it's interesting, that were in providing finance to the delivery riders, whether it's Mr. Delivery or Take a Lot, Checker 6060. So the riders there typically own their own bike, but they have to go and borrow the money or they have a rent to own. So it's interesting. One business came to us and said, look, they need funding. And their focus was to launch electric bikes into this space because it's environmentally friendly and ticks all the boxes. It was too early stage for us to look at, so we declined. But we then, another business came and approached us. They were looking for funding, and they've been around for 3 years. They do a buy-to-let, a rent-to-own model over 18 months. Interestingly, clever enough, they actually, if you're a rider for say 60/60 pays your weekly salary into their account. They deduct the rental and then they pay you the balance. So they credit control that way. And then the bikes get serviced and tracked all the time. And on a monthly basis, the bikes get tracked. Now we like that business because it's gone beyond startup. It's got many million rand turnover. It's at break even. And their biggest shortage is that they just need capital to be able to buy more bikes that they could put into their rent-to-own pool. So very interesting. But this is just to talk about if you want to be all, again, I'm not trying to, if you want to be sort of correct, you can say, oh, the EV one, fantastic, because that's the future. And the other one I said, what about why don't you look at electric bikes? He said, seriously? Do you think that the delivery guys, the riders, want an electric bike? Where they're going to charge it at night? Where's their port? You've got to charge it through the day. It's the most ridiculous thing to contemplate that you're going to have an electric bike when you're doing deliveries. And it's just interesting how you sometimes get just that cross sort of insight. Because at face value, the other one looked really great. Gee, I like this idea. But when you start understanding the market, so that's another one that we're looking at. So those are the space that we're coming. And then I think, did I mention one in the water space, a top up for, or second investment for Titech. In terms of just maybe to give you a feel for how do we look at businesses, once you've been through the due diligence process, which is the standard, understand the business, the product, the revenue, the market, does it have any competitive advantages, we apply different valuations depending on the nature of the business. So some businesses are asset rich, so you do a net asset value. Some businesses, especially if they are high growth businesses, and asset light, so you're buying future earnings, you have to, as best possible, do a discounted cash flow. And anyone that knows DCFs are, you're going to try and be least wrong. Okay, I don't think you can be right, but you can be least wrong. Other businesses that are slightly more mature, we put a multiple on, so like a 3 times earnings or something like that. But once we've done a valuation on the business and our investment committees approve that method of valuation, we use that same methodology over the years to assess and value that business. We don't, if we bought a business on a 3 times earnings, we don't next year change it to 4 times earnings to pump up the value. We'll keep applying that 3 times earnings. And that, for example, is one of the things the auditors are always looking for, is just a consistent, common sense valuation approach to each investment. So each of these 5 examples I've just mentioned now will have their own idiosyncrasies from a valuation perspective. Just
Yeah, would it be possible, and to do this regularly, is to get a copy not only of the presentations, but also profiles?
Yeah.
So we all have contacts, and some of us have clients that would be interested in using these services, and it would be helpful. And to the extent that you're doing a capital raise where you're not funding,
yeah.
if we could also get that information, because again, we may want to invest alongside, we may know people who want to invest alongside. But you're doing the hard work of finding the potential targets, and you might welcome some additional capital.
No, we love the idea of, so definitely, so the answer is yes on both. And we love the idea of co-investing as well. Well, thank you. Yeah. Great. Have we filled up the 10 minutes, or has Brad got one? Oh, yeah. So Janet at the back there has spearheaded an initiative at Invequity called Connect to Grow. In fact, we'll send an update and a reminder to everyone. But really what it is exactly that. It's to actually say that if you are interested in joining the Connect to Grow, it's not that you're going to get bombarded with email, but basically you're granting permission as one of our client companies, that we highlight our different client companies, but we also highlight our investee companies. And the possibility then just to either network or realize, well, actually, you know what, I've training needs, I might as well use Quelanga or the likewise. But on the co-invest one, we I didn't mention it, but a number of our investments are co-invested. So, for example, Prime Stars, we co-invested with Women's Development Bank. Mandini is co-invested alongside with the NEF. So we actually do like the risk spreading of other investment partners into the business. We prefer it if they do the due diligence and we can piggyback off them, but sometimes we have to do the work.
Sorry, Geoff, I
Yes.
just want to add. So, yeah, the Connect to Grow, I will be sending out the next executive summary towards the middle of December. So if you are interested in joining, there is a Papaya consent form that you just have to fill in and register on the B1 link prior to that. And basically, as Geoff mentioned, it's just your executive summary of your company. We've had a lot of synergies come from that. So it's going to be an ongoing thing. Cool. Thank
Great.
you.
Cool.
Thank you, Geoff. Thanks, everyone. I think, Geoff, that investment update, being that we are a fund manager and this is actually our core business, was great information for all who are attending online and here. We'll now just break for some tea and probably also for you to just have a thought around, what you've heard, and if there are any other questions, please note them down. We will have a question and answer session afterwards. After the presentation by Mandini. Thank you, and we'll be back at around, I think, 12 minutes past 11. And 30 seconds. Okay, thanks.